welcome to Big Deal. We are in the middle of 2024 and the big event of union election is behind us, looking at the first budget this particular month. Now it's time to also take stock of Deal Street as well as transactions so far and also gauge the way forward. Let me welcome on Big Deal today Vivek, Soni of EY India and Gaurav, Sood from Avendus Capital. Thank you so much, gentlemen, for joining us right here on CNBC-TV18. Now, Vivek, starting with you, when it comes to mergers and acquisitions, of course, we've seen some competitive intensity in some of the sectors, especially like, say, cement amongst conglomerates. But overall, it has been fairly muted because of several reasons. What is your view on the M&A so far in this particular year?
Thank you, Nisha. It's a pleasure to be here. To answer your specific question, see, if you look at the data, the first half of 24 has been better than the previous two halves we had, the 23 first half and second half, almost by, 18% and 44% compared to the second half of 23. So things appear to be on the upswing if you look at the past 18 months as far as the first 6 months of 24 are concerned, right? Most of the deals that happened were M&A oriented. We had close to, if I remember correctly, 26 odd billion of M&A in the first half of 24, right? And yes, certain themes have played out, like consolidation in cement being driven by the two majors. There has been consolidation in some other sectors as well, like media, on the technology side, on the renewables and infrastructure side. We've had many transactions. In pharmaceuticals, we've had transactions. Going forward, are we going to see more of M&A? Well, it appears that the animal spirits remain high. We've had a return of the NDA 3.0 government. There is a lot of optimism in terms of outlook. Markets are at an all-time high. And the valuations really, because of that, are the ones which is the headwind. How do you get deals done when the expectation on private trades is so high?
Yes.
Right? So I see that as a possible headwind, but everything else seems to be playing out in the right direction.
Right. So, Vivek, you made a very interesting and an important point. Everybody was watching out for the union elections results. But one important aspect that I really gauge from most of the foreign investors as well as companies is that in this particular union budget, they are going to also see how much continuity is there in a coalition government versus BJP standalone majority government. So that's also one of the hurdles that needs to be crossed for taking a long-term view on India for 5 years. Now, Gaurav, one of the biggest themes for this year, continuing from last year, is also the block deals, and especially from the private equities selling out, even exiting companies through block deals, and that has also muted the M&A street to a large extent. We've already done about $18 billion. What's your view on ECM trades? Because it's coming thick and fast from all corners, even promoters selling stake.
Yeah. Yes. So, Nisha, as you mentioned, of course, block deals have been the flavor of the season, not just for the first half of this year, but even last year we saw about $24-25 billion worth of block deals for calendar 23. So clearly, I think couple of things. And if you see, block deals are there not just from private equity funds. We have seen some of these global strategics do block deals in their Indian subs. We have seen promoters do block trades. So clearly, I think one thing is, for sure that Indian markets have become more robust, liquid, and block deals are giving a lot of these private investors or private equity funds an opportunity for exit, which possibly is not there on the private side, or as Vivek said, the valuation arbitrage is significantly higher than probably it was 3 to 4 years back, because the way markets are trading today. So today, a lot of private equity funds believe that they could exit a significant majority in the market through IPO and subsequent block trades. They have confidence in Indian markets that some of the large mutual funds and FIs potentially could own anywhere between 5 to 10% individually in each of these companies, which was probably not the case, a few years back. There is a trend of more companies now having 100% free float and no real promoter. Those kind of companies we are seeing in the market, more and more examples every 3 months. So clearly, we feel that with the depth of the market, the emergence of domestic capital, there will be more exits through secondary markets, especially for private equity funds, but opportunistically for promoters and strategics as well.
So since you rightly mentioned it's an opportunistic trade, who's buying, Gaurav? How's the investor sentiment? And also we have seen some new pockets of investors having big cash really invest and buy it out. How's the momentum building on that category of investors?
So Nisha, I think the flavor of the season, as you are seeing in the secondary market, even in block deals, we would like to, I think one thing we are very clearly seeing is that domestic investors are anchoring a lot of these large block deals, even some of the blocks which were $1 billion plus. We saw the anchor investors were the large mutual funds in India. So clearly, the mutual funds have stepped up the game significantly higher, potentially order sizes anywhere between 200 to $500 million from single mutual funds if there is a large block trade. But also the good part is that while the FIs on the secondary market have been selling opportunistically on transactions, companies which they are overweight on, positive on, we have seen FIs also participate in these transactions. So transaction wise, it's a good mix of DII and FII, but still the deal momentum is provided by the domestic mutual funds.
You know, Gaurav, in the recent past, this has come as a very big surprise and a very important theme, because earlier any large deal used to be supported largely by the FIIs. In the recent bulk deal data also, we have seen that FIIs have been sellers while the domestic investors have been the net buyers. And this momentum is really continuing, and this is a very big theme because Indian investors are really owning the Indian growth story and fueling that growth as well. Absolutely. So this is a very important theme. Now, Vivek, we're talking about exits. Give us a sense of the private equity mindset. And when there are more exits, then the investments are also being squeezed, because exits have been also driven by the good valuations provided by the equity market. But on the flip side, the same valuations look very high when you want to go and buy into a company.
That's absolutely right, Nisha. And in private equity, they say there are times when you sow and there are times when you harvest. With the public markets so high and looking at increasing the bid-ask spread on private transactions between what a PE investor is ready to pay, looking at long-term average multiples and what the seller wants, you know, the reality is that the seller will go to the equity markets, is increasingly looking at going to the equity markets. Nowadays, companies with even 100, 150 crore EBITDA are saying we want to go to do an IPO as opposed to explore a private transaction because the arbitrage is very high. For PE investors who have been putting in a lot of investment at play from pre-COVID to 21, 22, the companies which are growing fast, even they are looking at IPOs. So this huge valuation that the public markets are giving is proving to be a headwind for PE transactions.
Yes.
Nonetheless, PE investors are very innovative. You come up with structures which can be linked to valuation, and it's not that when you look at deal value in the first half, it's higher than the last half of 23, or for that matter, is the highest in the last four halves. As far as the calendar halves, as far as deal value is concerned, almost $31 billion of PE investment have happened in the first half, which is 59% of what happened in all of last year.
Yes.
And now we have the elections behind us, and the animal spirits, as I said, for investors is very high.
Yes.
And we see no reason why we will not outdo the first half in the second half. I mean, there
Right.
does not appear to be any headwind to prevent that from happening.
All right. So the second half of this year is going to outdo the kind of investments that private equity has made. And they have done significant amount of work on M&A, especially with their shift towards more buyout transactions. But Vivek, one more theme that is picking up is that the promoters, and rightly so, are also getting greedy. And in buyout situation, they want their share in the pie as well in terms of getting the right valuation. So that also is a big dampener in terms of conversion. But also, most of the large private equity players have increased their deployment towards India for this particular year. Vivek, which sectors are looking on top of their list to really deploy?
So, Nisha, the sectors haven't really changed. If you exclude, say, in the real assets category, you got infrastructure and real estate. They've done very well in this first half. They will continue to do well. There's a lot of appetite for owning control of yield-generating assets across various classes of infrastructure and real estate. So besides that, when you look at pure play PE, the top sectors really have been financial services, technology, e-commerce, and pharma and healthcare. And we don't see any reason that this will change going forward. These sectors account for almost 70% of all the PE investment that has happened in the first half. And if you go back even 3-4 calendar halves, this ratio doesn't change much.
Right. No, this ratio is not going to change. It's very hard to really, break that particular pattern. But in the recent past, Vivek, earlier this year, a lot of private equity players were also showing some interest in manufacturing, infrastructure and industrials. But we'll have to see how these capital-intensive sectors can really gain from an equity funding, which becomes very expensive for these kind of companies because debt is ultimately cheaper. On that note, we'll slip into a short breather on the show. But Gaurav, Vivek, lots more to talk. And since the equity market transactions are so hot right now, IPOs and also other themes playing out there on the deal street would be something we'll discuss right after this short break. Stay tuned. Welcome back. You're watching Big Deal and we are discussing the first half of 2024. How has it been for the deal street, the key themes picking up, and what is it that we are looking at when we talk about the second half? Now, Gaurav, one important theme is the IPOs. And while there have been several IPOs already, but the momentum as well as the pipeline is looking much stronger for the second half. Diwali is obviously a very good time where a lot of companies want to play on that momentum for higher valuations as well. But especially from the startup world, we are seeing a lot of interest coming in from some of the big unicorns really coming into the market in the second half. How is the picture looking?
So Nisha, overall the IPO pipeline is very strong, and as we've seen even in the first half, there is a lot of appetite for some of these new age companies in the listed side. We saw a lot of block trades happen in these companies, and I think that momentum will continue. A few of these companies have already filed, and in the next couple of months, you will see them hit the market and list in the next couple of months. So potentially from, I would say, August, September onwards till end of the year, there can be 2 or 3 large unicorns that could come to the market. But overall, a lot of companies are now beginning to start the IPO process, beginning to appoint bankers. So in the next 12 to 18 months, we believe that about 20 to 25 billion dollar of new market cap can get added to the new age businesses, which augurs very well to the whole ecosystem.
20 to 25 billion dollars being added by unicorns or the startups alone. That's a very big number, Gaurav. But we'll talk about some bit of valuation and investor appetite. But Vivek, how about the valuation dynamics at the current moment? And how are you viewing that from private equity perspective? And what are the key themes picking up in their investment strategy?
So, with the valuations so high, one of the key things that private equity is diligencing and trying to get a robust view on are growth prospects. Because the only way you can do the deal is you have an underwriting thesis that you'll grow into the valuation very quickly and it's going to sustain beyond that. But the bid-ask spread is a huge challenge. In certain cases, private equity funds are using smart convertible structures or ratchet structures. So you agree a base valuation, and in case it really goes to where the selling party is saying, then they earn into it as opposed to paying for it upfront or enshrining it upfront. private equity investors, they're not wrong because they have to look at long-term averages. Now, if you look
Yes.
at most sectors right now on the public markets, we
Hmm.
are on the top quartile when it comes to long-term 5-year average or 10-year average, how these businesses have been valued on a multiple basis,
Hmm.
right? So we are looking at a cyclical inflection point in the terms of how Indian public markets are valuing certain businesses.
Hmm.
And like you said, it has a bearing on deal activity in the private market.
Hmm.
But folks are getting around it.
Yes.
Then there remain secondary transactions. We had a large secondary transaction, the Healthium transaction. Now, they will always be businesses which are owned and controlled by private equity funds, which, because of or want of a one-shot exit, may not want to explore a public markets route,
Hmm.
right? So they hand over the asset to another, counterparty on the private equity side who is willing to take that risk for the next phase of the company's growth, and
Yes.
possibly they may want to. So there are these dynamics, and there are so many businesses in India right now where majority equity ownership is with sponsors, be it VC funds or PE funds, for various reasons which are specific to their exit timelines. They may want to explore a secondary transaction, as some large deals we have seen. So
Right.
on the whole, while the over high valuations are a dampener for growth of PE, there are enough opportunities because of which we'll see the dollar value of PE investments increase in the second half when
Yes.
compared to the first half.
All right, so that's an important point you mentioned, Vivek. And of course, the monetary aspect and the fiscal aspect is also very important, because the interest rates also have not been so high for the foreign investors into India for so long. And that wish list of the interest rate being cut by US Fed has also been there and in cold storage for a very long time. It has to be seen whether now finally this year we can have, or in September, whether US Fed really cuts the rates finally. So that's also an important driver. But when we talk about the delisting norms, how is private equity industry taking it, and what is the impact on the deal street as well as the momentum from the investors, Vivek?
Look, these norms have just come about. Folks are studying them, including our firm and the law firms we work with. Uh, the first view is that, look, it's a step in the right direction, because as opposed to this reverse book building process, you have now, a fixed price methodology which can be done. Uh, there was too much of to and fro. That said, the norms as we read it do not appear to, have a mechanism for counter offer. So, the way we see it, two challenges still remain, which makes it difficult in India to go in for a voluntary delisting. Uh, One is the fact that you go ahead now with a fixed price, and in case the equity investors uh, do not positively accept it, even a no response is deemed as a no, and your counter offer, your delisting offer would fail, and then you can't take a crack at it for the next 6 months. By that time, the price would have moved up or could have moved up.
Yes.
The second challenge, as we see it, is this requirement of a 90% threshold as far as the equity shareholding approving the listing is concerned. It's very high. When you look at the US, it varies from exchange to exchange, but even they max out at 75%.
Hmm.
And here we want 90% of the public shareholders to sort of approve, which still makes it difficult. So, our take is it's a step in the right direction. The reverse book building, is not the only option. You have this fixed price option. But we believe it could be finished further, maybe by giving the mechanism of a counter offer within that time period of 6 months.
Hmm.
Uh, and obviously, relooking at these thresholds,
Right.
because it makes it very difficult to get it done otherwise.
Right, so fair point. And most of the times the MNC players have always looked at how easy is the exit, and they have always given the feedback that the delisting process has to be much smoother, and the regulators have been making efforts. Each year there are some flexibilities, some norms being relaxed. Now, Gaurav, despite all this, the Indian stock market momentum is just so high that MNC listings is something that we are clearly looking at. Give us more sense on that.
So Nisha, we all saw, the Hyundai has filed, and that I think will start a clear precedent, which we believe is a very long multi-decadal trend that will start in India, that a lot of global companies across Europe, Asia, US, who have significant operations out of India, will start to look at listing and listing these subsidiaries in India. Obviously, one driver is the fact that in some of these Indian companies or Indian subsidiaries have a valuation 2x to 3x of their global parents. So there is a significant valuation arbitrage for the Indian listing. Of course, SEBI working to make the regulations more robust is also encouraging some of these global companies to start looking at India as a viable listing option. We do understand that at least 8 to 10 companies are very seriously exploring India listing and will get the ball rolling in the next 6 to 12 months. As I said, this is a long-term trend, and potentially in the next couple of years, you will start seeing 3 to 4 IPOs from the MNC side to list in India. Obviously, the other thing is that these Indian listings provides a deep pool of domestic capital, which for these MNCs, if they are listed overseas, they do not get access to the domestic mutual fund appetite, which is available for the subsidiaries. And
Yes.
along with that, the other theme that's playing out linked to the MNC listings is the fact that a lot of global Indian companies which were incorporated overseas for taxation or attracting private investors are now thinking of redomiciling back to India. So while technically these are not MNCs, these are Indian businesses, but they were incorporated outside. Even they are now looking to flip back the structure and list in India, basically because of the deep investor base that is there, the domestic capital, and the overlap of large FIIs is very strong in India vis-a-vis any large global exchange. So this is a multi-decadal trend, as I said, and this has just started.
Right. So Gaurav well pointed out because Ghar Wapsi has been a theme for which the industry has been lobbying with the government to relax it more. And one of the fintech companies has already paid a huge tax for that reverse flip already. So other companies are probably also lining up, but it's an expensive affair. But the Indian markets probably will give the kind of returns which will cover up for the expense of flipping back. I think that is one decision that they are really looking at. But these are key themes. Thank you so much, both Gaurav as well as Vivek, for giving us some great insights on how the deal street is going to look like in the next 6 months. And looks like that it's going to be quite hectic and the deal makers are going to be quite busy. Thanks so much for joining us on Big Deal, and thanks to all our viewers for tuning in.